On track here. A new book about Black Tuesday and the fallout on Wall Street and beyond hits the shelves today. 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation is now available. The author, CNBC Squawk Box co-host, New York Times financial columnist, DealBook founder, subject of a 60 Minutes piece this Sunday, Andrew Ross Sorkin.
Come on, again, I mean, it's royalty here. No, seriously.
I'm sitting at the table of kings and queens.
This is the first time you've ever been on this show.
I was going to say, I feel like...
Is this what it takes?
I've been on the show, but remotely. I don't think I've ever sat here. I am like a first-time caller, long-time listener kind of situation.
Well, we are
going on.
Thrilled to have you, Andrew. And this book is unbelievable. You've been talking about it for months. You've been working on this for 8 years. So 8 years ago, you had no idea, I don't think, that an AI, quote-unquote, bubble would be brewing in the markets at the time of the book's release.
I had no clue of any of this.
Right.
The truth is, I wasn't even thinking about that.
And so tell us about the book and what you hope viewers to get out of it in the context of what is going on today.
So the truth is, I just wanted to understand. I'd written Too Big to Fail. People used to come up to me and say, how does that compare to 1929? And I'd say, I knew something terrible happened in 1929, but I didn't know who the people were. And what their motives were and incentives were and all of the things going on behind the scenes. I think we all sort of have a conception, there was a crash. But it's always a story about people and their decisions. There's a lot of great books, by the way, about 1929 that are written by economists and other things. But as I was writing this book, and I'm seeing these amazing characters, there's so many things happening in the headlines that all of a sudden are like exactly like then. Whether it is what was called investment pools, where people are manipulating, very meme stock oriented kind of stuff, almost GameStop-y kind of stuff going on. The leverage that was in the system. There was no private credit back then, but there's some parallels to what was going on today, what the Fed was doing in terms of interest rates at the time, what they were not doing in terms of the political pressure. We all talk about the independence of the Fed and whatnot. And then, of course, we get to this AI bubble that seems to be going on, and we're clearly in a bubble. The question, of course, is when's it going to pop? In my mind, we're in a bubble. But the question is, and I don't think we're heading into 1929, by the way. The question is, are we in 1999? I talked to Paul Tudor Jones on Squawk about a week ago, and he said we're in the fall of 1999, October 1999. The tricky part about that is the market still had 40% to go.
Right. Yeah.
So you got to know when to get on and off the train. And I think that's the hard part right now. We talk about all the circular deals. By the way, there were circular deals left and right back then in the craziest ways.
We dig you, Andrew. We say it all the time. Let me ask you this. So you won't let a 16-year-old drive a car. The Federal Reserve was 15 years old.
Yep.
I think it was formed in December of
1913.
1913. That's a little bit different because they were probably scared of their own shadow at that point.
That's exactly right, by the way. And they were so scared of their own shadow. The reason why they would have wanted to raise interest rates a la what Volcker did, but they were so scared of the political pressure, not that they were going to get hauled in front of Congress, that the Fed would be just eliminated because they were so new. And I think, by the way, Ben Bernanke, who becomes, of course, the chair of the Fed in 2008 during the subprime crisis, he did his thesis on the Great Depression. I think he realized what you need to do is flood the system with money and do things that are so politically unpopular. So when people talk about politicizing the Fed, that's the thing I worry about. It's not today. It's when you get into a crisis, will you have a Fed that will do things that the public doesn't want them to do, but maybe the right thing to do?
What about the tariff situation at the time?
Oh, gosh.
Parallels to that.
Yeah. So almost hilariously, as I'm working on this, of course, we're having tariffs in this country. So back in 1930, President Hoover had pledged, by the way, as part of his presidential campaign in 28, he was desperate to get farmers to vote for him. And so he said, we're going to do tariffs. And so he felt like he needed to do this. Every economist is writing open letters the way they were to the president just a couple months ago saying, we beg you don't do this. All the bankers were going down to Washington, D.C., to the White House saying, they're on their knees to him saying, please don't do this. Of course, he does it. Global trade falls by 60% a year later. Now, it's a little bit different today because these deals are being done bilaterally. At the time, it was like what Trump was trying to do almost across the board back in April, meaning just everybody, here we go. And so we'll see where it shakes out. But clearly, that was another. Talk about dominoes. The crash was really a psychological break in terms of the market and the economy, and then a whole bunch of other policy choices were made that clearly went the wrong direction.